aware of what it takes to comply with these two new accounting standards. So in the Grant Thornton network, containing about 140 countries and 70,000 people, we were able to identify a very, very well adept resource speaker who resides in Melbourne, Australia, to help us get through and understand and be aware of what the two new disclosure standards are all about. And we are very grateful that he agreed to talk and be a part of this seminar. And without further ado, I will pass the floor now to our resource speaker, who is the head of the financial services and a partner at Melbourne office of Grant Thornton, Australia, Darren Scammell. Over to you.
And thank you, Ron, and thank you, Chindapik and Peseth. I'm honoured to be here. It's a real pleasure. And as was mentioned in introduction, being past president of Chartered Accountants Australia and New Zealand, I really have an affinity with KICPA and your members. And I also know how important this suite of changes in the accounting standards and the disclosure standards is going to be to accountants going forward, because it is us as accountants that will need to implement these changes, disclose these changes. And the reason I say that is because it's the accountants who are best at gathering information. We are the best at following the accounting standards, auditing standards, and that sort of thing that I think this is all applying as well. In fact, I've been using the term accounting, and people think of accounting as just dollars and cents or money. It's not. It's about taking account of how many sheep there are in the paddock is accounting. How much carbon is used is accounting. And I think that we are quite used to using this terminology. And I would like you to be talking to all your clients and your staff and people doing high school, coming through schools. What's exciting about becoming an accountant? Because it's much broader than accounting. I'm going to share my screen and walk you through the presentation. As mentioned, we can have time for questions at the end, plenty of time, in fact. I hope you can all see my screen. Good, 6 and nods, thank you. As mentioned, head of financial services, but at Grant Thornton Australia, just recently we've developed up our own ESG and sustainability group. So I'm a member of that group, partly because of the passion I have for sustainability and ESG. Today's program is going to be, what is ESG and sustainability? I know it's headed up S1 and S2, but I think it's really important that we understand what is meant by sustainability, and that S2 is the first step in many steps that are going to be implemented beyond the accounting, beyond IFRS accounting standards. And S2 is the first. I'll talk about S1 briefly and what S2 is, but I think before I do that, let's understand why ESG and sustainability is so important. I'll describe what they are, why is an important topic, what we're doing in particular in Australia, and I am tapped into the Grant Thornton global network of what's happening into ESG. I've got a particular example in the health sector, but I'm also going to talk about banking and a little bit about manufacturing, which is relevant to you as well. What are the opportunities and challenges? Please don't see S1 and S2 as just more reporting. It's an opportunity for you to run, and as accountants, to oversee businesses in a better way, and really talking about the different sectors that can apply to. What is ESG? I know some of you will know, some of you may not know. So I'm actually starting, fairly at the bottom, if you like. E is the environmental side of things, S is social, and G is governance. Where this started was, I understand, in Canada, where the broking and investments community wanted a better way and another way of looking at a company beyond just the financial results and the projected results. And they felt that it was better that investments be taken place in companies that are better at managing the environment. They are better across the social side of things. How do they manage their relationships with employees, their suppliers, their customers, and their communities? And how well are they governed? And given it's a starting in the globally, more and more companies that get better at the environmental, social, and governance side of things, when they're compared with other companies in their industry, decisions will start to be made about investing in companies with a higher ESG. Sustainability is used with ESG interchangeably. I actually see sustainability as, will the company be there in 5 years' time? Is it sustainable? And we talk about sustainability with sustainability, so environmental sustainability. Is the planet environmentally sustainable? So remember that sustainability is more than just the environment, the E. Sustainability includes the social, how well it's governed. So please keep that in mind. I might use it interchangeably, but that's what's happening globally. People make the mistake of thinking sustainability is just about the environment, and it's not. So we'll talk more about this. This all came about in 2015, United Nations Sustainability Development Goals, and there were 17 goals that were put forward. So it really came about from then. That's some time ago now. That's 8 years ago. And you can see, you know, the goal of the UN, let's have no poverty, zero hunger, good education, gender equality, all these things. ESG is linking into this. And what a lot of companies have been doing, because there's no mandated disclosure requirements until S1, S2 has come out in most countries, they've been following these goals. So a lot of companies have been saying, you know, if we're an educator, we're about good education. For example, we've got good health and well-being. Obviously, the health sector is good in that. So what does a manufacturing company have to do in order to support good health and well-being? Well, maybe they could take more sugar out of their food. Maybe they could actually, food that is less processed. Maybe there's more information on the packaging. So all companies, even manufacturing retail companies, are looking at some of the UN goals, and it is linking into ESG. Gender equality is a very important one globally, and we're seeing real movements in there. In fact, in Australia, there's a report coming out only next week about the companies, about the pay gap that exists between men and women, and there's a lot of focus on that. And that's linking there. So a lot of companies are starting to report that. Remember, that's within the S of ESG, gender equality. Decent work and economic growth is also one that is relevant, particularly across Southeast Asia. You know, we talk about S1 and S2. S4 may well be around slave labor. So what's happening there? So you can see how ESG and the S1, S2 is linking into the UN Sustainability Development Goals. Remember, sustainability is more than the E. It's about the future. And reduced inequalities too, which is really important. That's the wealth gap, as I said, across countries and within countries. So there are 5 of the areas that GT has particularly been focused on, supporting our companies with how they report. It's just going through climate action, obviously, is one that is linked to the E. So what is your company doing about climate action? What are you doing about minimizing your carbon? What are you doing about planting new trees? What are you doing about less waste water? What are you doing about less waste, full stop? You can see that these are linking, the UN development goals are linking into ESG and the reporting that are coming out of S1, S2. And I'm saying that because I think our employees, our people that are buying from us, our boards, our investors are all wanting to see this. And this is the response, is ESG to the Sustainable Development Goals. So who are the stakeholders? And I think this is a really important thing to understand. This is not the regulator that's asking for this information. I mean, this is coming out of the IFRS in the UK, largely where it's run. There's been a merger of the Sustainability Accounting Standards Board out of the US, has merged into the the IFRS under the Value Reporting Foundation. So it's not about regulators wanting to, or governments want to see this, of course, they want to see an improvement. I actually think E and S in particular is going to be driven by corporates across the world. And the reason is because they have so many stakeholders. Who are they? They're the people that have a vested interest in your ESG. They could be your employees. So 25-year-olds that want to come and work with you because you have better diversity and equality for men and women. Or you might have a better E in using less carbon than another business in your industry. So people are starting to make decisions. They are a stakeholder. Your directors are stakeholders. Obviously, your shareholders are stakeholders. The government agencies are stakeholders. It's really important to understand it's quite a broad spectrum. They play an important role in shaping your ESG and sustainability response. Your directors may want revenue or dividends to be paid. Employees want to be working in a good environment, and that's a clash of often of like needs. So that's really important to understand just who the balance is and where the who wants to see what information from an ESG perspective. And it's really important. There's a good story of Heineken, the brewing company, and the Dutch company, and the CEO came on board some 4 or 5 years ago now, and he didn't understand his industry as well as perhaps he should about where they could save in carbon. So he put a notice out to all employees to ask them for suggestions as to how they could do things better. And it was amazing. He got the whole organization behind him in understanding how better they could do from a climate change support perspective. It wasn't just being led from the top. They were part of the stakeholder process. I love to talk about greenwashing and bloomwashing. I hope you've heard the term greenwashing in particular. It came about in the 80s of a young man, Jay Vesterveld, was an American student, and he was traveling across Asia Pacific to go surfing in Bali, is how I understand it, and he stopped in Fiji. And in Fiji, he couldn't afford very expensive accommodation, but it was in cheap accommodation next door to a very expensive hotel. And the hotel was advertising the fact that its towels were being washed every day. And he sat back and looked at the pristine water in front of him in the bay in Fiji and knew that the chemicals cleaning those towels was growing straight out into the bay. And that's where this terminology about greenwashing came from. It might be a wonderful thing that you've got clean, pristine white towels, but you've got pristine bay that's being killed by the chemicals from that. That's greenwashing. And I give the example of some of the big cola companies, I won't name which ones, producing water in bottles. They advertise the fact that water is healthy for you, but plastic is not healthy for the world and the environment. So there's a conundrum there. That is greenwashing. Blue washing is a more recent term, and this is where you'll say make commitments and actions in an organisation around social practices, where you say we will be equal pay for men and women, and you're not. Or you might say that you are, from a social perspective, you're diverse, equal opportunity for all people of all nationalities and all genders, when you're not. That's greenwashing. So, sorry, that's blue washing as a distinct to blue washing. What's happening in a lot of countries now is that the regulators are looking very closely at this. You'll see that there are court cases being held. The regulators in Australia are particularly looking very closely at greenwashing and blue washing to make sure that entities aren't making incorrect statements. And that's why S2 is going to be very closely monitored. You say as an organisation that you are carbon neutral and you're not. So that's where things are going to get really difficult, I think, for some entities about how they go and report and how accurate that is. So it's what it happens with the deliberate intention to mislead or misrepresent. That is the greenwashing explanation I go. So carbon emissions. Let's, before we dive into S1 and S2, just what is it? There are 4 levels of carbon emission. The first is quite easily understood. That's direct emissions, owned and controlled. So we as an organisation are pumping, the carbon into the air because we actually have a process that is generating carbon issues and problems. So that's reported, and there's been a lot of reporting of that in Australia under the National Greenhouse Emissions reporting that's been undertaken for some time. Scope 2 is indirect So that's where I actually buy electricity into my organization as an example, and I'm having to report how much carbon is impacted by that electricity. I read only on the weekend that Australia has 1/3 of its energy now comes from green resources. So it can be from wind or turbines from water or the sun. So 1/3 of our energy. So it's not all electricity is bad. It's where the energy comes from to create the electricity. So that's really important. We've got a lot of people now, entities are coming into corporates and actually looking at the invoices from their energy providers and taking the amount of electricity that is used and converting that to carbon emissions. So there's a big process going on around there, around that. Indirect emissions, scope 3 are the harder ones to collect. So we at Grant Thornton, Australia, only 3 months ago, put out a survey to all our employees asking them how they got to work. If they work from home, what power do they use at home? Do they have solar panels on their roof when they're working at home? How do they get home from work? When they're at work, how do they travel? What sort of vehicles do they use? That's indirect. That's in your value chain. For a manufacturing environment, that would be sending out product to your customers, would be part of that. It's in the value chain, but it's not actually purchased energy that you have. So that's scope 3, often done by surveys out to third parties of the organization or your employees. Scope 4 is a new one that's coming in. It's outside the product chain. If you were to develop more energy efficient products, for example, we used the plastic example before, let's turn to plastic that takes less energy to create or less energy to break down. Break down probably is what I'm really meaning. It's and avoid emissions, and that's also being sought, and that's going to be asked to be disclosed. So again, that's a difficult one to gather. I'm an auditor. How do you audit these things going forward? That's going to be quite challenging. I've noted their scope 3 is not very precise. In fact, at Grant Thornton, Australia, if we're talking Chatham House rules, only 30% of our employees actually responded to that survey. And I hear that's about right. People are busy. So is 30% a fair reflection of the actual scope 3 emissions that occur with our employees? What happens to the other 70%? It's that 30% that we're using to when we report externally on how much carbon emissions we have at Grant Thornton, Australia. Double materiality is another one to think through, where an organisation considers both how its business is affected by the environmental issue and sustainability issues, and how its operations and activities have a social impact. Remember before I had, you've got investors, you've got employees, you've got potential users of your products. So you've got different materialities. What's important to one person is less important to another. I may wish to buy from a certain company and I don't care if it has carbon emissions, but I really care if they provide diversity of employment, as an example. So there's these different materialities depending on who the stakeholders are. And that's something that an organisation needs to spend time and consider, because you can't report everything, otherwise it'll be a 500-page report. We need to be short, succinct, and sharp in what we're reporting. I mentioned before just how all this is coming about. So the financial reporting standard setting organisation, the IFRS, sits up at the top. The Internet Standards Board is coming underneath that. We've got the Task Force on Climate-Related Financial Disclosures. There's the Global Reporting Initiative, the GRI. We're calling this the alphabet soup across the globe. There's so many acronyms coming together, but it is gradually coming together now. And you'll see there where the Value Reporting Foundation has underneath it the SASB and integrated reporting. And integrated reporting, I'll talk a bit later, that's where we're heading ultimately, I think. But what's happening is these are the reporting frameworks that are coming together and they're creating under IFRS. Now we're going to have S1 along with the IFRS accounting standards. So these are some of the acronyms that you'll have heard people being talking about. Why is it so important? Well, the fundamentals of ESG already exist. Climate has increased the prominence. I'm not here to discuss whether humankind has created the climate change issues that we have. The fact is, all the world has decided that we need to do better at climate management and less carbon usage. So the horse has bolted, as we would say in Australia. So we need to keep up with that reporting and that framework that is being brought out. It's a priority for many governments around the world, as you can see. But the trouble is with governments, they get voted in and voted out, of course. So I really see this as being important. It's going to be corporate-led, this type of reporting, and that's why we have S1 and S2. The environment is permeating down through the supply chain. You may well have heard certain companies, they can't sell shoes because those shoes were made by perceived slave labor. There's S, right? So people are starting to make decisions about what they'll buy. People will buy tuna that has been caught environmentally way, rather than big ships catching them with nets out the back. The people are really starting to make decisions about the environment and how better to use things and buy things. So it's making change in organizations. It's definitely going to be a primary focus in the short to medium term. You hear terms like people saying that there's a 1 in 30 chance that climate change will be the end of humankind within 100 years if we don't do something about it. So again, I'm not saying humankind is causing that, but if we are, we need to be doing something about it, and that's the way government's approaching it. So social issues, I think, are becoming more and more prominent. I mentioned before, S1 is the framework under which we're reporting. S2 is carbon. We'll talk about that. There is talk that S3 will be about reporting on nature. How much water do you use? How much of impact do you have with your waste? That sort of thing. S4 could well be slave labor. S5, I personally am hoping it's what's called integrated reporting. And this is where organisations will be expected to put into their financial statements or reporting somewhere just what their business is. How do they run their business? What is how do they report in an integrated way and put that information into their financial statements? We're hoping, a group of us is hoping that might be S5, and it'll be that the business model is actually going into the accounts. And that's going to be difficult to audit. At Grant Thornton Australia, we're actually talking about a huge, huge industry coming as a result of all these new standards and all this reporting. It's going to have to be prepared, it's going to have to be reported, and assurance is going to have to be given to it. Wow, imagine if we are starting to have to report and audit the business model of an organisation. So that's where these social issues, it's all becoming part of more and more reporting is going to be asked for. And regulatory change is starting to drive that. Governments are really making it happen. So what do we mean by carbon targets? Now we're drilling down into the S2 and how we get there. Carbon neutral, net zero, right? So an organisation may well say that we are carbon neutral. They might use a whole lot of electricity, but they might buy credits from a company that plants trees. So the tree planting will offset the use of the carbon that's being used by that organisation. So for many years, one of the major banks in Australia, I assigned their greenhouse emissions report. They describe themselves as carbon neutral. They're a bank, admittedly, which is not a huge user, but if they've got hundreds and hundreds of branches across the globe, vehicles, people flying planes, big IT centres use a lot of electricity. To get them to be carbon neutral, they had to go and buy carbon credits from plantation companies, basically. So that's an interchangeable term. Time-related targets. So this is interesting as well. So a lot of the regulators are saying, you're making statements by saying that you anticipate to be carbon neutral by 2028, I don't know, 2030, something like that. many companies just say this and haven't mapped out how they're actually going to get there. So we, Grant Thornton, I'm an auditor, we're actually saying to our clients, don't put that in there. If you haven't got a proper plan to get to carbon neutrality, don't disclose that fact, because that's more important. But then that's greenwashing. Remember, I talked about that, just saying, yeah, we're going to be carbon neutral in 5 years' time. You can only say that if you actually have a process in place and a map as to how you're going to get there and disclose that. Otherwise, it could be greenwashing. So to achieve the targets depend on external factors. Who knows what's happening in the world? You could be criticised if you actually say you're going to get there and you don't. People have invested in you or come to work with you or bought your product from you because you say you're going to be carbon neutral and you don't achieve that. So there's quite a risk there. And it's open to marketing spin and greenwashing. So just be really careful about what carbon targets really mean. So the role of reporting on ESG and sustainability. So what are we doing here? We're giving greater transparency. There's been some issues, historically, I've probably been around a long time. A lot of corporates don't like to give too much information out because they say, well, that's confidential information, it's competitive. I flick it the other way and say, now you need to be providing this information. People are investing in you and they need to know, you need to be transparent about what you're doing in this ESG space. You can tell the overarching story and your activities, it's better information. You now have a methodology you can follow to actually provide this information. You're aligning now with your competitors or your peers as we see more and more ESG coming. We as investors, prospective employees can actually compare organisations much better. Globally, we can compare. I mean, some it's used for branding. One of my clients for a number of years was a bank that was very proud of its sustainability. You go onto their website and it's green trees and waterfalls and that sort of thing. It's a bank. They've been very successful in saying how they are sustainable in everything that they do, and people like to bank with them and work with them because of that. So what does industry play? I mentioned before the governments like to drive these things. I truly believe this is going to be industry-led. Industries or activities are considered harmful, have a negative impact, have been under more pressure. The big miners, the big coal miners, the big plastic producers, the big energy